With the autumn budget just announced here in the UK, there's been some big changes that might impact investors. So in today's video, we're going to go through those key points and also see Vanguard's take on it. There was a lot covered in the autumn budget, and I'm not going to go through every single item. Instead, I'm going to go through things such as inheritance tax, capital gains tax, income thresholds, and also pensions. I'll also cover some of the smarter strategies and workarounds that you can implement on your portfolio to make sure you're not too heavily impacted by this new budget. So if you're curious to see how these new changes might impact your portfolio, then keep watching. Okay, so starting with one of the biggest changes, and that's in the form of capital gains tax. The Chancellor announced that the lower rate of capital gains tax will increase from 10% to 18%, while the higher rate will increase from 20% to 24%. These increases are effective immediately and will bring rates in line with capital gains tax payable on property that isn't your main home. Now, capital gains tax is a tax on the profit that you'll make when selling a particular asset. This would include investment items such as shares, funds, bonds, and even property, but not the property that's your main home. So essentially secondary homes like holiday homes or buy-to-let properties. Now, everyone has a capital gains allowance, and this is currently set at £3,000 per year. Anything over this is subject to that capital gains tax. Now, a key way to get around this is to make use of your ISA or pension accounts. Both of these options will shelter you from any capital gains tax. The key point here is that they do differ from general accounts, so if you have some investments lay in a general trade account, maybe consider moving that over to an ISA version of the same account. Under the current rules, you can invest up to £20,000 in ISAs in the 24 tax year, which ends on the 5th of April 2025. The annual ISA limit will remain at £20,000 until 2030. This limit applies across all your ISAs, including cash ISAs and stocks and shares ISAs. You can also invest up to the lower of £60,000 or 100% of your gross relevant earnings in pensions. So if you combine both the ISA and the pension, you essentially have an £80,000 allowance per year to invest without being hit with any form of capital gains tax where more liquid investments are concerned. Now, moving on to pensions, we've been relatively unscathed, at least for the short term anyway. There were rumours that the Chancellor would limit the amount of tax-free cash you can take from your pension in retirement to £100,000. This did not happen, which means you can continue to take up to 25% of your pension as tax-free cash, capped at £268,275 over your lifetime. Now, if you've made a request to take your tax-free cash because of the rumoured changes in the budget, you might want to think about whether it's still the right decision for you. You can change your mind as long as you're within the 30-day cancellation period and meet other relevant criteria. Now, the other thing that people were worried about where pensions are concerned are the introduction of a flat rate of pension tax relief. Again, this didn't happen, which means basic rate, high rate, and additional rate taxpayers will continue to receive tax relief on 20%, 40%, and 45%. Depending on your personal pension contributions. The tax relief one was quite a concerning one, but I think we've come out okay there. Now, where pensions and inheritance tax come together, there's been some changes that may impact that. Now, currently, pensions are excluded from an individual's estate for inheritance tax purposes. Now, for example, if you had £200,000 within your pension upon death, this would be passed down to your beneficiaries with no tax paid. From April in 2027, however, any money left in your pension will be included in your estate, which means it will be subject to 40% tax if your estate exceeds the inheritance tax nil rate band. This might be something to consider when you're deciding how to fund your retirement and potentially how much you leave for the next generation. This leads us nicely into inheritance tax altogether. Now, last week's announcement means that inheritance tax nil rate band will remain at £325,000 until April 2030. And if you're in a married couple, essentially you each get that £325,000, which can pass to either partner when they die, which means effectively you have a joint nil rate band of £650,000. There's also a residence nil rate band, which is £175,000. Again, this is being frozen till 2030, and this applies to anyone who's leaving property to their descendants. Again here, this will be joint, so you'd have a limit of £350,000 that you could leave without receiving any tax on this. Overall, a couple could essentially leave £1 million before any inheritance tax is due. Okay, so moving on to national insurance, insurance. So the Chancellor announced that the rate of employer national insurance will increase from 13.8% to 15% as of April 2025. Employers will start paying national insurance when employees' salary hits £5,000, and this is down from just over £9,000 currently. Now, while it won't directly affect employees or investors, it might impact people in other ways in terms of getting pay rises or even pension contributions. If you have a workplace pension, it might be worth reaching out to your employer to see if they're going to implement any changes here. If they are planning to change this, it might be worth looking into how you can top this up and make up the difference. For example, you could make up the difference within your workplace pension, or you could even open a personal pension yourself. Next we have income tax, and this is one of the big ones that people were worried about. The income tax rates are being frozen until 2030, so it gives us a little bit of assurance going forward. Now, whilst it might appear quite good, there's actually a bit of a downside in the background. You see, the income levels in the UK are slowly creeping up, as they generally do, but the income tax rates are staying the same. So essentially what we're going to get to by 2030 is a lot more people paying the higher or additional tax rates. Again here, using tax efficient accounts such as ISAs and pensions are a great way of trying to manage that. So to summarise, the autumn budget does bring in some changes that impact investors, particularly in the form of capital gains tax. In light of all these changes, I'd say it's crucial that you review your financial plan. I'd be using ISAs and pensions where you can to help navigate these new rules and help protect your investments. I'd love to hear your thoughts on this budget, and I'd also love to hear if you're making any changes to your investment strategy in the comments section. As ever, if you've enjoyed this content, feel free to like and subscribe for any future videos. Thanks for watching, and I'll see you in the next one.